Now, Hong, I know you have a traditional finance background. You did your MBA at Booth, and you worked at Goldman Sachs in investment banking. Did it not bother you after your experiences there to invest in something like Bitcoin that doesn't inherently generate any cash flow like stock would?
No, it doesn't.
No.
It's really about utility of an asset. If the when we think about, for example, gold and other commodities, the use of the case is just utility. It's not there to generate cash flow. That's totally fine. But also, for example, if we look at equity or fixed income, those asset classes are there to generate cash flow. So when we think about valuation, we have to think about future cash flow. Mm-hmm. But Bitcoin is a very unique asset class. Right now, we're talking about it as an asset class, but fundamentally, when I think about the valuation framework, I think it is there as a valid alternative, a store of value, not just because it's an asset class. Ultimately, I think it will become a monetary, global monetary system, a fundamental layer that can actually be there and protect our wealth.
Okay. All right, Han, let's talk about regulations now. Changes in OCC regulations have allowed financial institutions to now use stablecoins as a means of financial settlement. What does this mean? Can you just explain in layman terms the mechanism behind this regulation?
Yeah, I think it's a great news that we see at the beginning of 2021 because it sent a strong signal basically saying that OCC, which is a major financial regulator in US, is actually embracing crypto blockchain as a part of a fundamental settlement framework that can be competing against SWIFT and some of the other legacy settlement framework in the financial system. So that recognition in itself is pretty big. It shows, again, the trend of institutional adoption. Last year, OCC actually came out with an announcement that banks in US can legally offer custody services to crypto. That was a pretty big move forward. And this one was even a step further. And we think about when you think about crypto transaction, actually, over the last years, stablecoin was actually a major part of the transaction volume. And there is really a good use case for a stablecoin being a major transaction volume coin out there, because it basically in developing countries, and a lot of people not only use Bitcoin as one of the kind of exchange medium, but also stablecoin, which is pegged against US dollar. So that can also lead to a even further development, a growth in stablecoin in the coming, I would say, 1 to 2 years.
Can stablecoins replace existing financial settlement mechanisms?
I don't think it's there yet. I think there are still a lot of technical limitations. For example, USDT, USDC, some of those US dollar pegged stablecoin. Right now, majority of them are running on Ethereum, and there is scalability with restrictions on Ethereum. So I think there's still questions out there on whether stablecoin in the future, how much can it scale, right? In terms of in real, once the adoption really picks up, how much can it scale? I think that remains to be seen. But at least that it's a good starting point that the regulatory framework, we're seeing recognition in embracing it as a fundamental settlement alternative.
Okay. So, Hong, you are the CEO of OKCoin, one of the world's largest exchanges for cryptocurrencies. I'd like to know what the more popular altcoins in 2020 have been on your exchange. Have any coins risen in popularity that may have surprised you?
2020, in addition to Bitcoin, which, again, takes the dominance in the market, about 73% of the volume. Ethereum definitely comes next. Ethereum is basically a layer where a protocol that allows smart contracts. So a lot of applications can be built on top of it. So Ethereum actually community has the largest developer community out there within crypto. So definitely the experimental spirit is fully exhibited there. So Ethereum has been very popular. Now, on top of that, we also see a lot of DeFi tokens coming up, a lot of them being built on Ethereum. For example, Uni, which is a token of Uniswap, one of the largest DEX out there that basically grew within a month. Volume of transaction on Uniswap basically overtook the volume on Coinbase within 2 months or three months.
Wow.
So Uni also actually has been pretty popular as a token. Polkadot, its native token DOT, has also been very popular. But again, it's also related to some of the fundamental dynamics where you see a lot of interesting projects being developed on Polkadot, a competing protocol against Ethereum. So there are a lot of interesting things out there. But within crypto, if you think of Bitcoin as the blue chip equity, you tend to think about Ethereum and a lot of the other DeFi tokens as more like the VC type of early stage investment. A lot of experiments going on.
Can you tell us about the opportunities that DeFi has created for different products to emerge? Like, for example, just to name a few, OKCoin I know has produced a product that earns or promises 12 to 20% APR. Can you explain how that works?
Yeah. I would, yes, happy to, but I would say not promise because nothing can be promised. So what happens is in DeFi, there are actually a lot of smart contract out there, protocols out there that people go in and then they put their money into those protocols and they earn a yield. So that's why yield farming has been very popular last year since the summer. But one of the challenge with DeFi, actually two challenges with DeFi that again exhibit its early stage nature is that number one, the user experience is really tough because you have to actually go through a lot of steps to be able to put your money into DeFi and earn a yield and actually be able to track where you put your money into and what are the yields, because those yields do fluctuate quite often. And secondly, those protocols mostly were, again, built on Ethereum. And when transaction volume goes up, the scalability issue actually exhibits itself as another challenge. So sometimes you actually see gas fee, which is a transaction fee, when people put in money into a protocol, try to earn some yield. And then when they withdraw, they have to withdraw it. On both deposit and withdraw, you actually have to pay transaction fee, which is called gas fee. And that gas fee can be quite big, sizable compared to whatever money you put into the protocol and earn a yield on it. So those two are actually pretty big pain points for people who are trying to use DeFi to earn yields. And not to mention that there are a lot of technical hoops that you have to jump over to be able to use it. So from our perspective, we want to be able to provide a good access to DeFi so that people can actually start to understand what's going on and also have an alternative for putting their money to use and earn some yield. So we actually have a DeFi Earn product that we put out where we basically build the rail where you can actually use our interface and then you pick which DeFi token you want to put your money into, basically in form of stablecoin. And then we pull your money in through that rail that we built and then send to those protocols to earn yield on top of that. And it's redeemable on a daily basis. So there is a generally you'll be able to see an APY for each of that quote unquote DeFi pool, and you can redeem your money on a daily basis. Why I'm saying we're not promising any API because number one, we don't touch money. The money that any customer put into the pool will be directly sent to the underlying protocol, and that yield will actually fluctuate with market on a daily basis. But it's a great way for people to actually see how they are putting their money to use, and they're not going to pay any gas fee. We're actually covering gas fee for our users, actually. So we're trying to address those two pain points. while giving people a easier access introduction to DeFi, which is very much, again, a very early stage innovation within.
Yeah, I'd love to follow up with you in another interview and talk about payment structures and more DeFi products another time. It's very interesting because one of the questions that I've been getting is why even put your money in a bank now? Banks don't pay you 10, 12, 14, 20% yield on your savings. But anyway, that's a topic for another time.
I'm happy that the banks are not charging you for putting your money into their account, because that's what's happening in some parts of the world. So. Yeah,
that is true. I mean, the flip side is they pay you a yield, but they also probably charge you a lot of money as well. Yeah. But okay, well, my last question for you, Hong, I've heard some analysts mention that Ethereum has superior technology to Bitcoin and can one day surpass Bitcoin in market capitalization. Can you briefly comment on whether or not you think this is true, and if you disagree, why?
I would disagree, but not disagreeing in that Ethereum has inferior technology than Bitcoin. I think those two are built for very different use cases, and they're also in very different stage of development in their own life cycle. Bitcoin, again, is built as a store of value. It's built to really give people a peace of mind, a saving technology. The supply, again, is the supply algorithm is built into the code, so nobody can meddle with it, and it is expected to be very stable. As a result, if you look at the developer community, Bitcoin Core, the way any changes to the underlying protocol is reviewed and any revision is proposed, it's a very rigorous process. And it's supposed to be so. It's very stable. And I would say that early days of Bitcoin, there's still a lot of internal development and hard forking going on. But I think after 2 major hard forks and also 3 successful halvings, the underlying protocol is at a place where people feel generally comfortable with it. And then the use case as a store of value is being embraced by a larger population and growing population right now. Ethereum, on the other hand, is really built to allow smart contract, meaning that people can actually build apps on top of it to really build use cases, internet use cases in a crypto world. However, the underlying technology that we're seeing in Ethereum and many other competing protocols are still very early stage. That scalability issue that we mentioned, right? If, for example, if you actually do a $100 transaction, you have to pay 90 gas fee on a DEX. Is a great example that it's still not scalable. Not to mention, back in 2017 on ICO run, people the reason that actually people got excited about it is that prospect of Ethereum being potentially becoming the future computer, world computer, and seeing a whole internet being rebuilt on top of Ethereum. However, the scalability issue quickly brought to people that's actually, there's still a long way to go. When you are trying to buy a virtual crypto asset on the Ethereum platform, and you have to pay a huge gas fee on top of it, it's just not feasible to see the whole internet being built on top of it. That's not saying that it's not possible. I think there's still a lot of experiment going on. Ethereum upgrade to Ethereum 2.0 was an example of that. But still, there's still a long way to go. So I think those two are very different use cases, and Ethereum is still a very early stage in its own development versus Bitcoin. So yeah, I wouldn't compare those two in those type of a strict language, saying one technology is superior than the other.
Fair enough. All right, Hong, thank you so much for your time today. It was a very good talk, and I look forward to following up with you again. Thank you.
Thank you. Thanks, David.
Thank you for watching Kitco News. I'm David Lin. Stay tuned.